The start of 2025 has felt like an extension of the last year's themes, but with one key shift. The first interest rate cut is now behind us. That move, anticipated by most of the market, has already started to change the mood. But we're not in a boom cycle yet. Far from it. What we're seeing so far is a market in a holding pattern. Buyers are cautious, sellers are recalibrating, and prices in many areas have started to level out. So, with the market in transition and the second half of the year shaping up to look very different from the first, the question becomes, what should investors be paying attention to right now? There are a few key areas, starting with interest rates and borrowing power. In February, the RBA announced its first rate cut, a 25 basis point move that brought the official cash rate down to 4.1%. For most borrowers, this translated to about $100 a month in reduced payments. Regardless of the exact number, the direction is clear. Rates are falling. And as they do, borrowing power will improve. There has been also policy shifts that could change the dynamics for certain buyer groups. For example, the Federal Treasurer recently directed banks to disregard student debt when assessing mortgage applications. But it's important not to get ahead of ourselves. None of these changes mean the market is about to take off immediately. What they do signal is a slow but steady shift. The other major force is supply, or more importantly, the lack of. The National Cabinet has set a target of 1.2 million new homes by mid-2029. That breaks down to 240,000 new dwellings a year. But by November last year, only 169,000 had been approved, already 30% short of that target. And even among approved projects, many haven't made it into construction. There's an estimated backlog of 250,000 approved but unfinished homes. All of this points to one thing. Supply isn't going to catch up anytime soon. And while demand might fluctuate with rates and sentiment, that structural shortfall is likely to keep a floor under prices, particularly in high demand areas.